Hey traders, Nick Shaheen here looking at making a point. What's the point today? The point is that options offer ways of trading things and theories and thesis without putting a lot of money on the line. So I'm going to use a real life example with GE. I do a newsletter, I share my thoughts every day, and this is one things I shared a couple months ago. I can't remember exactly when, but we'll look at it. So it's GE. Nobody was talking about it. It's still a monster. They still have a ton of income, and they're streamlined their businesses to 4 main businesses, and they're relevant. So I like it. I liked it going forward. Nobody was talking about it. Everybody was happy chasing Zoom and all that, all exciting stuff. This is the bread and butter. I made a bet on Ford bullish before that, like a couple months before that. It made me money. I rolled out. It was my, quote, America trade. And this was another bet on America trade, which is another great American company that has gone into the toilet because of bad management. Recent management, the newest management, seemed to be doing the right stuff. All right, so let's look at the lines I drew. The opportunity was, it was nowhere near the opportunity here. It was that I knew it had a bottom. And I knew that if I was given the shares at 5, which would be lower than the COVID low, I would take them. So I wanted to catch an upside move. I didn't have a scientific trigger for it, so usually I don't do anything. In this case, what I did, I went out to next year and I bought leaps, calls, but I also sold puts. So I was basically long for almost free. In fact, I can't remember the number, so let's go check them out. This was a practice account where I did a presentation on it, and I use it as an example. It's close to the real trade. So what did I do? I sold December puts for this year at 5, collected 35 cents. What was the point? The point is I collected $350 on 10 contracts, for example, and the worst I could do is own it at 5. That was the worst I could do. I keep the $350 in my pocket. That's the risk I'll take. The company makes 95, 100 billion. It's not going bankrupt anytime soon. So it's a risk I'm willing to take from $5 down. That brought me income. And then I spent some money buying upside. So in this case, I said, I'm going to buy next year's $7 calls. They were not in the money, but they were just there. I paid 80 cents. And based on this example, so my real numbers were a little off of that because this was a practice account where I had to demonstrate the trade, but the concept is still the same. So what's the end result? Now these are $1.35, $1.45. I think at the high today they were probably $1.50 because it's giving back a little bit. Today it's up 7%, by the way. Today is 10.28, but it doesn't matter. The concept is the same. So going long with a thesis gave me income from selling puts, income from buying calls. Combined, I made basically $800, give or take, out of nothing almost. I risked 500 basically because I spent 800, but I collected 350. So I got this much. So it's an easy way to implement a thesis. So I didn't have a specific trigger like this breakout. I saw this breakout coming. I lined it up, but I jumped the gun by buying it down here somewhere. I can't remember where. So when I don't have a particular trigger, I need reasons to chase it. The way I, quote, would chase it is very softly by buying leaps. So they're slower and selling recent risk into high VIX situation. So the puts I sold were exaggerated because everybody's nervous about everything right now, right? So this was one way to capitalize on that. And I can buy back this bet by spending 6 cents, giving back some of the profits. Big whoop, I still made $290. And I made another $530 from this. So how do I implement this? I just go here and I'll say close. I'm going to have to pay up because this is a practice account, so I want to keep it as an example. So I would close it like this. So I'm paying $30 to take the bet off. And I should pay $55 if I were closing all of it. And if I hit send, filled, gone. All right, so now it's gone. How do I close the other one? I do the opposite. I just close it. I'm also going to close 5 so I can use an example again. I'm going to take less because this is a practice account and I want it to fill quicker. So here, credit I receive because I'm selling something. the 665, and then I give back some fees, blah blah, and it's going to queue on me. All right, so you get the point. It hasn't filled. It'll open a little bit and it'll fill. So the point is, options can be scary if you misuse them. If you use them logically, like for me to lose money on a $5 ownership of GE stock, which is down here, means that the whole market is collapsed. Means that the SPX is probably in the 2000s, 2500, 2400, 2200. So I've got bigger problems than just GE falling. So using logic there, I put some risk there to take in some money. I let time be my friend. When I buy a call, time is my enemy. If I bought stock, that was also valid because all I need is just sit on it. I bought calls, therefore time is my enemy. But I sold puts, therefore time is my friend. The two offset each other, and I was willing to sit in that risk. It was a small risk to pay. So let's take a peek here. It's skewed. I don't know why. Cancel it. Screw that. All right, so it is a practice account. Let me see here. I'll close it again. Maybe it was a freaky. How about if I give them, all right, I don't want much. Give me $1.30. Wait, am I going the wrong way? I think I'm going the wrong way. That's why. No, boom, it's gone. All right, so I closed half of the trade. So I booked the profit. They can't take that away from me. I still have risk if I left 5 and 5. What's the risk? If it falls below 5, I still have to buy the shares. If it falls, I may lose some of that premium. It may go back to 80 cents, may go back to 7, may go to 0, may expire and never get there. You get the idea. Nick signing out.